Something feels off right now, doesn't it? Markets are shaking, headlines are screaming about geopolitical tensions, and everywhere you look, people are either panicking or pretending everything is fine. Gold pulls back a bit, silver hesitates, and suddenly the narrative flips overnight. It's over. The bull run is dead. But here's the uncomfortable truth most people don't want to hear. This kind of chaos is exactly where the biggest opportunities are born. I know how it feels to watch your portfolio dip. Even if it's just on paper, it messes with your head. You start questioning your decisions. You wonder if you got in too late, or worse, if you completely misunderstood the market. And when everyone around you starts shouting different opinions, it becomes even harder to stay grounded. But let me offer you a different perspective. What if this pullback, this fear, this confusion isn't a sign that things are falling apart, but a necessary step before something much bigger happens? Because right now, most investors are making one critical mistake. They're focusing on what's happening today instead of understanding where things are heading next. And in investing, that's the difference between reacting and winning. Let's flip the question. Instead of asking, why are gold and silver struggling right now? We should be asking, what conditions are being built underneath the surface? Because if you zoom out just a little, you'll notice something interesting. Despite all the noise, gold is still holding near historic highs. Silver remains one of the top performing assets in recent years. And more importantly, the fundamental drivers behind these assets haven't disappeared. In fact, they've quietly become stronger. Here's where most people get it wrong. They assume that rising oil prices, geopolitical conflicts, or even the possibility of higher interest rates automatically kill momentum in precious metals. That sounds logical on the surface, but history tells a very different story. There have been multiple periods where oil surged aggressively, and guess what happened? Gold and silver didn't collapse. They thrived because what really matters isn't just one variable like oil or interest rates. It's the broader financial environment, especially how fragile the system becomes under pressure. And right now, that pressure is building fast. Think about this. Global debt levels are exploding. Governments are spending beyond control, and the cost of maintaining that debt is becoming unsustainable. At some point, something has to give. Either interest rates come down or the system starts to crack. And here's the key insight most people overlook. The market cannot survive significantly higher rates for long. Not governments, not corporations, not even consumers. Which means eventually the system will be forced back into easier monetary conditions, whether through rate cuts, liquidity injections, or inflation being allowed to run hotter. And when that happens, that's when gold and silver don't just move. They explode. Now, does that mean prices go straight up from here? Of course not. Markets don't move in straight lines. They shake people out first. They test conviction. They create doubt. And that's exactly what we're seeing right now. But underneath this volatility, something much bigger is forming. A setup that, if you understand it early, can completely change how you approach investing in the next few years. So before you panic, before you assume the trend is over, you need to understand what typically happens next, because this phase we're in right now, it's not the end of the story. It's the beginning of the most important chapter. Now, to really understand what's happening, we need to step away from emotions and look at patterns. Because markets may feel chaotic in the moment, but over time, they follow surprisingly consistent cycles. Let me simplify this. There are moments when everything looks strong on the surface. Stocks are rising, confidence is high, liquidity is flowing. That's usually the late stage of a financial cycle, and then something breaks. It doesn't always look dramatic at first. It starts with volatility, sudden drops, uncertainty, conflicting signals. Sound familiar? What we're seeing right now is not random. It's what typically happens when the broader market begins a correction phase. And here's the part most people miss. Precious metals don't peak before the chaos. They peak because of it. Historically, gold and silver tend to go through three major phases in a bull market. Phase one, accumulation. Smart money quietly builds positions while nobody is paying attention. Phase two, recognition. Prices start moving, more investors join, momentum builds. In phase three, is where things get interesting. That's the final leg up, the explosive move, the part where prices accelerate rapidly and often overshoot expectations. But here's the catch. Before that final phase begins, there's almost always a shakeout, a correction, a moment where even confident investors start doubting themselves. If you go back to the early 2000s, after the stock market peaked, commodities, including gold, entered a long bull cycle. But it wasn't smooth. There were pullbacks, deep ones. In 2008, during the financial crisis, everything dropped, including gold. And yet, what happened right after? Gold didn't die. It entered one of its strongest rallies ever. The same pattern showed up in earlier decades too. Different triggers, same structure. Which brings us to today. Right now, we're seeing early signs of stress across the global system. Equity markets are unstable. Liquidity is tightening in certain areas. Geopolitical tensions are adding fuel to the fire. This is not the environment where bull markets end. This is the environment where they evolve. And here's something even more important. Not all assets respond the same way during these transitions. Stocks, especially overvalued ones, tend to struggle when conditions tighten. But hard assets, things that cannot be printed, cannot be diluted, start gaining attention. Because when trust in the system weakens, people naturally move toward things that hold value outside of it. That's where gold comes in. That's where silver becomes even more interesting. Now, I want to address a concern that a lot of people have right now. What if we enter a recession, or worse, deflation? It's a fair question, because in theory, a slowdown in the economy could reduce demand, especially for industrial metals like silver. But here's where today's situation is different from the past. Silver isn't just an industrial metal anymore. It's a strategic resource. It's being consumed in massive quantities across industries like solar energy, electronics, and advanced technologies. And supply is not keeping up. That imbalance doesn't just disappear because of a temporary slowdown. Even if demand softens slightly, the structural shortage remains. And when supply is tight, prices don't behave the way people expect. Now combine that with monetary policy. Every time we've entered a recession in the last 2 decades, what did central banks do? They cut rates. They injected liquidity. They made money easier to access. And every single time that happened, gold and silver benefited. So even in a downturn scenario, the response from policymakers ends up supporting these assets. Which brings us back to the present moment. What looks like weakness right now may actually be preparation. What feels like uncertainty may actually be positioning. Because if history is even partially correct, then this phase we're in isn't where the opportunity disappears. It's where it quietly multiplies, for those who understand what they're looking at. Now let's zoom out even further, because if you only look at the current market, you are missing the real story. What's happening right now isn't just a correction. It's part of a much larger transition. There's a concept that very few retail investors truly understand, and that's the idea of secular cycles. In simple terms, markets don't just move up and down randomly. They go through long periods, sometimes lasting a decade or more, where certain asset classes dominate. There are times when stocks outperform everything. And then there are times when hard assets, like commodities, gold, and silver, take over. These cycles don't overlap perfectly, but they often follow each other. When a long-term bull market in stocks starts to fade, that's usually when commodities begin their strongest runs. We saw this in the late 1960s leading into the 70s. We saw it again around the year 2000. And if you're paying attention, you're seeing early signs of it right now. For over a decade, stocks have been the main game in town. Easy money, low interest rates, and constant liquidity push valuations higher and higher. But now that environment is changing. Debt is too high. Inflation has become a real problem. And the system is struggling to maintain the same level of growth without consequences. That's not a small shift. That's a regime change. And during regime changes, capital rotates. Slowly at first, then all at once. This is why I've been saying that what we've seen recently in gold and silver isn't the peak. It's the early signal. If we compare this to previous cycles, the move we've experienced so far looks more like the middle phase, not the final blow off top. And that matters because it changes how you position yourself. Now, let's talk about something that's making a lot of people uncomfortable right now, the market crash. Because let's be honest, it doesn't feel good to watch everything drop. Portfolios shrink, confidence disappears, fear spreads quickly. But here's the uncomfortable truth. A reset like this is not only normal, it's necessary. Without it, the next phase can't happen. Think of it like pressure building inside a system. If it never releases, the system eventually breaks in a much worse way. But if it releases in controlled bursts, corrections, crashes, volatility, it creates space for the next move. And in the context of gold and silver, these corrections often act as the launch pad for the final leg higher. Not immediately, but inevitably. Now, I want to address a common criticism. Some people say this is just an excuse. Every time the market drops, you move the goalposts. But that's not what's happening here. This pattern, this sequence of expansion, correction, and then acceleration has been discussed by experienced investors for years. It's not about being right every day. It's about understanding the structure of the cycle. And right now, structurally speaking, we are exactly where you would expect to be before a major move. Yes, the pullback has been sharp. Yes, it's uncomfortable. But let's not ignore what happened before that. The rally leading into this point was stronger than most people anticipated. And when markets move aggressively in one direction, they tend to correct just as aggressively. That's not weakness, that's balance. Now here's something that should really make you think. Even after this pullback, gold and silver are still holding a significant share of global investable value. In fact, their relative importance has been increasing, not decreasing. That tells you something critical. Big money hasn't left. If anything, it's positioning. And while retail investors panic, hesitate, or wait for better prices, institutions, central banks, and governments are doing the opposite. They're accumulating, quietly, consistently, strategically. And that creates a very unusual dynamic, because you're not just competing with other investors anymore. You're competing with entities that have long-term agendas, deep pockets, and access to information most people don't. Which means one thing: waiting for the perfect entry might cost you more than acting during uncertainty, because by the time everything feels safe again, the opportunity is usually gone. So where does all of this leave us? Right here, in what I believe is one of the most misunderstood moments in the entire cycle, because most people are still asking the wrong question. They're asking, is this the top? When the better question is, what happened after a system like this starts to break down? Look at the bigger picture. Rising debt, persistent inflation, geopolitical instability, increasing pressure on central banks to intervene. This isn't a temporary phase. It's a structural shift in how the global financial system operates. And in environments like this, history doesn't reward those who react emotionally. It rewards those who prepare early. Now, let me be very clear about my personal stance. I'm not sitting on the sidelines waiting for clarity. I'm not trying to perfectly time every move. I'm positioning slowly, intentionally, with a long-term view, because I don't believe this is the end of the metals bull market. I believe this is the setup for its most powerful phase. Could there be more volatility ahead? Absolutely. Ani. Could prices dip further before moving higher? That's always possible, but trying to avoid every short-term drop often means missing the long-term move entirely. And that's the real risk most people don't see. Not losing money in a correction, but missing the expansion that follows. Because when the next leg begins, and it won't wait for everyone to feel comfortable. It will move fast, faster than expected. And by the time headlines turn positive again, the majority of the move will already be behind us. So instead of asking whether this pullback is a problem, start asking whether it's an opportunity to reassess your strategy, to understand the cycle you're in, and to position yourself accordingly. Because at the end of the day, markets will always do one thing better than anyone else. They will test your conviction. And right now, that's exactly what's happening. If you've made it this far, then you're already ahead of most people, because you're willing to think deeper, not just react. And if you found value in this perspective, then here's what I want you to do next. Take a moment, step back, and really think about your current strategy. Are you reacting to noise, or are you preparing for what comes next? If this video helps shift your perspective even a little, make sure to stay connected, because what's coming in the next phase of this market, you're going to want to be ready for it. I'll see you in the next one.